Hey, how's it going, guys? Welcome back to the Module 2 of Technical Analysis Foundation, the complete professional trading course for beginners. Module 2 is all about chart reading basis. In this tutorial, we will go through the Module 2.5, talk about technical indicators, and share with you guys some of my favorite powerful indicators that I'm still using today to find profitable trade setups. So, what exactly are technical indicators? Technical indicators are a bunch of mathematical calculations based on price and volume data from the past, and are used by technical traders to visualize market historical data and predict future price movement. Technical indicators are widely used on different types of markets, for example, like stocks, bonds, Forex, and even cryptocurrencies. Every technical indicator has one or multiple mathematical formulas behind it. It's really important to go through the formula and understand how the indicator works before applying it to your trading system. It's very common to see professional traders use multiple technical indicators combined together in one trading system. However, it doesn't mean that the more indicators you use, the more accurate your technical analysis will be. There's no holy grail among technical indicators that can perfectly predict the market. There are thousands of technical indicators, but roughly they can be put into two main categories. Category 1 is called momentum indicators. These are the indicators that help you identify the trends that begin from a non-trending market or a breakout. However, they can frustrate you with premature signals in a ranging market sometimes. Examples are indicators like MACD, Bollinger Bands, and ADX, the average directional index. The second category is called oscillator indicators. This type of indicators help you see overbought, oversold conditions in the market. However, they can give you many wrong signals once the market starts trending, especially in a strong trend. Here are two examples: RSI, the Relative Strength Index, and a stochastic oscillator. One thing I would like to highlight here is that there are some indicators can be used in both categories. For example, some traders also use RSI, the Relative Strength Index, to measure the momentum of a market trend as well. So, understanding the formulas behind each indicator and how the indicator works is the key. Let's take a look at our first example. Also one of the most popular indicators for swing traders, which is MACD. MACD stands for Moving Average Convergence Divergence. It's a momentum indicator. Let's take a look at how MACD is calculated and how it works. In general, a MACD indicator has three parts: the MACD line, the signal line, and the MACD histogram. The default setting for MACD, no matter which charting software or charting platform you use, the default setting is always 12, 26, close, 9. And this is how it works. First, the MACD line, it is the blue line in the chart. The way to calculate the MACD line is simply take the value of 12-day moving average and the minus against the 26-day moving average. So that's why we have 12 and 26. The second part is the signal line. As you can see, the orange line in the chart, signal line is calculated by taking the historical value of MACD line and divided by 9. So that's why we have 9 in the settings. The third part is MACD histogram. It basically shows the value difference between those two lines. The larger the difference between these two lines, the wider the histogram will show on the chart, and vice versa. And by default, all prices are market close prices. It's important to understand how MACD is calculated. Because the market environment is always changing and there's no such thing called the best setting for all in MACD. You should understand how MACD truly works and adjust it to your own trading needs. But for swing traders, the default setting is good enough. So what exactly is convergence and divergence? The MACD line and the signal line are plotted as two separate lines, and you can see that these two lines cross over each other from time to time. As the difference between these two lines gets smaller and they get closer to each other, that is called a convergence. When the difference between these two lines gets bigger and then those two lines get further apart from each other, it's called a divergence. When MACD line and the signal line cross each other, we call it a MACD crossover. Some professional traders use MACD crossover to measure the momentum of a market. When MACD line crosses above the signal line, it's widely considered as a bullish momentum. When MACD line crosses below the signal line, it implies a bearish momentum in the market. One thing to be aware is that MACD is calculated from moving average data, which means it lags behind the price. Or for the professional traders, we always call it the lagging indicator. It may not be the best indicator for you if you want to get into a trend early, but it's a great indicator for confirming a short-term trend. Cool, after we go through the MACD basis, now let's take a look at how we can use MACD to help our trading. The main concept of MACD is that we use MACD in a higher time frame to define and confirm the current trend. Then we go to the lower time frame to find the trade setups in this current trending direction. Here's how it works. First, define your higher time frame. For example, if your entry time frame is daily, then your higher time frame should be weekly. Normally, it's a factor of 3 to 5. One higher time frame, if MACD line cross above signal line, it means market has a short-term uptrend with bullish momentum. Then go back to your lower time frame and look for long trade setups. On the other hand, if on the higher time frame, the MACD line cross below the signal line, it means that the market has a short-term downtrend with bearish momentum. Then go back to your lower time frame and look for short trade setups. Here's one example. This is a gold chart on the weekly chart from April 9, 2018 to July 15, 2019. In total, there were 4 MACD crossovers occurred during this time period. At point A, it was a bearish crossover. At point B, it was a bullish crossover. At point C, bearish crossover again. And at point D, bullish crossover again. So now let's take a look at how we can trade. First, at a higher time frame, the weekly chart, a bearish crossover happened at point A, so go to the lower time frame and look for short setups. This is the daily chart from April 9, 2018 to October 1st, 2018. And we enter our short position on April 9 at the price of 1,337. That's a return of 11.2% before we turn long position at the bullish crossover B. At the bullish crossover B, the market turned from a short-term downtrend into a short-term uptrend. So in the daily chart, we can see a clear uptrend from October 1st to February 25th, 2019. In the lower time frame, we find our precise entry point. So we enter our long position on October 1st, 2018, and that will result in an 11.5% return before the next bearish crossover happens. And the bearish crossover C is similar to the bearish crossover A. The difference is that the bearish crossover C creates a much shorter downtrend before the next bullish crossover occurs. The return is much smaller at 3.3%. At the bullish crossover D, the market turns back to a strong uptrend. So this chart ends on July 15, 2019. So here's the daily chart from May 27 to July 15, 2019 after the bullish crossover occurred. We used the lower time frame, the daily chart, to time our entry point. The price of the gold at that entry point is $1,414. So enter the long position at the entry point, and until the end of this chart, the return will be 13% during this last bullish crossover phase. I'm going to show you the live demo of the example I just explained you just now. So this is the chart of the gold price, and as you can see, I marked April 2018 to July 2019. So we're going to use the MACD strategy to trade this time period and see how it works. All right. So first of all, I want to teach you guys. So I'm on the TradingView platform. So I'm going to teach you guys how to add MACD as an indicator onto this chart. All right. So you come to right here, and then you just type MACD. So you just click MACD, and then there you go. And then you have the indicator, and below the chart. So if you want to see the setting, it's right here. You just close the Show Indicator Legend, and you will see the attributes of the MACD, the settings, 12, 26, close, and 9. And if you want to change that, so here is the setting menu for you to change. So we're going to use the default setting. All right. So what are we going to do right now is that we're going to go to the higher time frame. So right now I'm using daily chart. So I'm going to change to weekly chart. All right. Weekly chart, and we're going to go back to April 2018 to July 2019. All right. So right now, if we change to the weekly chart, it's much less noisy compared with the daily chart. And then we can clearly see the MACD line, how the MACD line action looks like. So clearly we can see there are 4 crossover happens. So here is number 1. It's around April 9, April 16 this week, during this week. So that's the when the MACD line, the blue line, cross below the orange line, the signal line, which means it's the bearish crossover. So here is a bearish crossover, and then next is the bullish crossover. So basically the MACD line cross and stay above the signal line. This is the bullish crossover. So bearish crossover number 1, bullish crossover number 1, bearish crossover number 2, and the bullish crossover number 2. So during this time period from April 18 to April 2018 to July 2019, we have 4 crossovers. That's exactly what we show in the example. All right, so I will go to the first bearish crossover and show you guys how you can exactly find the entry point. So we use weekly chart to see the market trends, how the market is trending with the MACD line. So basically the weekly chart shows the bigger picture, but if you want to find the precise entry point, you need to go down to the lower time frame, which is, for me, because I'm a swing trader, then I'm going to use a daily chart to find my entry point. All right, so when you go down to the daily chart, let's come back to the April 2018, and you will see the MACD line is more choppy than the weekly. But however, once we find the area, which means the bigger picture, that of the trends, then we know exactly what time period we're gonna look for exactly the entry point, which is around April 9 to April 16, around this time period. So then during this time, we can see that the exact bearish crossover happens on April 20th. So this is exactly the entry point we're looking for. And then we enter our short position on this day. Or you can enter on this day too, if you want to be more safer. So you can wait until the crossover happens and stay below the signal line. Then you can either enter on April 20th or April 21st, April 23rd. So this is the exact how you can exactly find the entry point on the lower time frame. All right. So let's come back to the weekly chart. When we come back to the weekly chart, we'll know that we're gonna find the next bullish crossover, which is around here, is the October 1st. So after October 1st, during this week, the blue line crossed beyond the signal line, the orange signal line. So when we look for the exact point that we're gonna buy cover our short position and turn long position, we should look during this period, October 1st, October 8th, around this time. So then we're gonna come back to the daily chart. We're going to come back to the daily chart. Remember that period, time period, which is around October, around this area. All right? It's around this area. So what we're going to look for is, we're going to look for the blue line cross beyond the orange signal line and stay over. All right? So there's a lot of actions around here, and then boom, here's the point. October 10th. After October 10th, we can see that the blue line has a very strong bullish momentum. So around this area is the time we're going to cover our short position, take the profit, because from this price to here, we made about 11% of the return if you short. It's from here. And right now, we're going to enter our... Okay, I'm going to draw the arrow if I can. All right. So as you can see, if we short over there, and then we cover our short position right here, that's equivalent to 11% of the return. And then we cover our short position here and then turn long position. And turn long position, let's come back to the weekly chart. Let's come back to the weekly chart. And then where's the next bearish crossover? The next bearish crossover is around this time. It's around March, the end of the March, the early of April, around this time. So we're gonna, around this time, the end of the March, the early of April. All right, so we're gonna come back to the daily chart. The end of the March, the early of April. All right, so this, the end of the March, the early of April. Okay, so here, this is the time we're gonna look for, and boom, this is the point, because during this, around this area, the blue MACD line crossed below the orange signal line. So this is the time we should sell our long position, take the profit, and then turn to bearish short position. All right. So I'm gonna draw. Use the arrow. I'm gonna draw over here. Boom. So this is also a pretty good profit, and so as you can see, bearish crossover. Okay, I'm gonna go to the weekly chart, so it's much easier to see. All right, so bearish crossover was short, and then bullish crossover, we take the profit from the short position and then turn long position, and then you repeat and you repeat. So this is how exactly you can use MACD crossover to trade the market. All right, let's continue our course. So what if your starting capital size is $30,000? Here's the result after you make all those 4 MACD crossover trades. From April 9, 2018 to July 15, 2019, which is about 15 months time, a starting value of $30,000 can turn into around $43,000 after that series of MACD trades. That equivalent to a total return of 44.7% return in 15 months. Pretty good. Especially, I'm going to compare with the buy and hold strategy. So here's an interesting comparison. If you buy gold on the April 9th, exactly same entry day that we had, you don't buy and sell, you just hold it until July 15th, 2019, your return will be only 6.6%. So this is the power of using MACD and taking advantage of those short-term uptrend and downtrend in the market. All right, let's take a look at another popular technical indicator called RSI. RSI stands for Relative Strength Index. It is an oscillator indicator that measures the ratio of up moves and down moves in the market to indicate overbought and oversold signals. Overbought is a situation when the price has risen more than the market expectation. On the other hand, oversold is a situation when price has fallen more than the market expectation. Here are the formulas behind the RSI. It has 2 parts. First, you use the average gain of the past n periods and divide it by the average loss of the past 10 periods to calculate the relative strength value. N is the number of RSI periods, which can be categorized by traders on your charting platform. For example, if you set N as 20 days, then your relative strength value will be your average gain of the past 20 days divided by the average loss of the past 20 days. The second part is just simply converting the relative strength value into an index number, and this is the formula to do that. Some professional traders also use RSI as a momentum indicator that measures how fast and strong the price is moving into a certain direction, a certain trend. The key is to understand how it works and the implication behind their calculations. This is how RSI indicator looks like in a real chart. It is a single line scale from 0 to 100 with an overbought line on the top and then an oversold line at the bottom. So now the key question is how to use RSI indicator to help our trading. First, let's take a look at how we can use RSI to identify overbought and oversold in the market. The default value for overbought line is 70 and the oversold line is 30. So the market is considered overbought when RSI line is above 70, and the market is considered oversold when RSI is below 30. These are the default levels. You can also adjust these levels according to your own objectives. For example, there are some traders they prefer use 80 for the overbought line and 20 for the oversold line. One thing to remember is that during the strong trend, the RSI may remain in overbought or oversold for a very long extended period of time. Second, we can also use RSI to identify the trend reversal. When the market is in an uptrend, the RSI tends to remain in the 45 to 90 range with 45 to 55 zone acting as an RSI support level. When RSI breaks this support zone level and then head lower, it indicates a potential short-term downtrend is forming. On the other hand, when the market is in the downtrend, the RSI tends to stay around the range of 10 to 55 with 45 to 55 zoom acting as an RSI resistance level. When the RSI breaks the resistance level and jump higher, it indicates a potential uptrend is forming. The third major application of RSI is called RSI Classic Divergence. This is how it works. When the price forms a lower low in the price chart, but RSI form a higher low in the RSI chart, that indicates the price will potentially bounce back and go up. This is called the RSI bullish divergence. On the other hand, when price forms a higher high in the price chart, but RSI forms a lower high in the RSI chart, that indicates the price will potentially pull back and go down. This is called the RSI bearish divergence. Here is a classic example of RSI bearish divergence. In the price chart, the price is making a higher high with low volume. And in the RSI chart, the RSI line is making a lower high. It's a classic sign of potential exhaustion of the current uptrend. So the markets pull back and then heads lower. Alright, right now I really want to share with you guys the importance of combining different indicators together. Pretty much all the professional traders I know, they do not only rely on just one single indicator in their trading. They combine different indicators together and let them work together. Each indicator is designed to do a certain job. There's no such thing as one for all indicator. Combining indicators is a great way to improve your edge in the market and give you more confidence in trading. However, it doesn't mean that the more indicators you use, the better edge you will have. It takes a tremendous amount of hard work to fully understand one single indicator, so please expect to spend more effort on exploring different indicators and finding the combination that works the best for you. Stop looking for the holy grail and blindly following other trading gurus' indicators. And last, please avoid being too obsessed about indicators and ignoring the most basic price actions. Remember, technical indicator is just a tool. We're not trading indicators. Our main focus of trading should be always on the price action itself and the underlying imbalance between buying and selling pressure in the market. In this course, we covered MACD and RSI as our two examples. However, there are thousands of different indicators out there. It's impossible to cover every single indicator in one course. But I will upload more tutorial videos on other technical indicators in the future to help you guys. Alright, congratulations guys! We have just completed the entire Module 2 with 5 sub-modules. Here's a quick recap on what you have learned in the entire module. Module 2 is all about chart reading basis. In Module 2.1, we went through what truly moves the price in the market and the 4 important chart reading principles. In Module 2, we learned how to read price candlesticks and the 6 powerful candlestick patterns that you can use for your trading. In Module 2.3, we learned how to identify support and resistance levels, and in Module 2.4 and 2.5, we learned how to use moving average and other technical indicators to help on your trading. I hope you guys enjoyed the tutorial video so far. We will continue this course to Module 3 and share with you guys how to analyze the market in a bigger picture. Again, thanks for watching, thanks for your support, and I can't wait to see you guys in the next module. Bye for now.